Okay, this problem is a lot simpler than it may seem at first. Think back to accounting 1 when you had a sale and it was on account. You would debit account receivable and credit sales revenue. Well, this is the same thing except that our item of value instead of an account receivable is an interest-bearing note receivable. So we debit the note receivable for $48,000 and we credit sales revenue for $48,000, just like we've done forever. Now we have to come up with our interest receivable for December 31st. So that's 6 months. So remember, our interest formula is always interest is the principal, which in this case was $48,000, times 9% times 6/12, and the interest receivable is $21.60. That's what that works out to. And that's interest revenue. It's another revenue stream. It would show up on the income statement as other income. Now, we're at the end of the next year. We have to calculate the interest and the cash that we are going to be receiving. And I like to get the easy stuff first. We know we're going to be crediting the note receivable, making that go away. So let's get rid of that. We know that's there. We have to get rid of the interest receivable. We know that's there. We have to figure out the interest revenue and the cash is just going to be a plug number of these three items added together. That's what the cash is going to be. So our interest is the same as it's always been. The principal times the rate times the time. In this case it's 3/12, and that's 1,080. So that's our interest revenue for this period. And when you add those together, we come up with $51,240 is the amount of cash we're going to get. Now the next thing it asks us, it says, suppose that you are a moron, and as such you forgot to record that $21.60. What would that do? That would understate our income. Okay, we would be stating too little because we're not picking up that $21.60 in receivable. Okay, that's an asset. That's interest revenue. So our income would be understated by $21.60. And the next year, if we pick up the entire amount of the revenue, the $3,240, we would be overstating our income for 2014 by the amount that we should have reported last year. So we would be overstating it by $21.60. Note that these two would indeed cancel out. The net effect would be 0. But the IRS doesn't like to look at things that way.